Okay, welcome back. Things are looking quite okay in this even keel. I mean, I think that's the way to put it. Banks, though, are under some pressure, as we've been pointing out. Prashant Jain is Chief Investment Officer at 3P Investment Managers. He's joining us right now on the program. Of course, Mr. Jain needs no introduction. He's one of the longest-serving mutual fund managers in the country. One of the most visible faces when one talks about investment management in India. Managed the HDFC Balanced Advantage Fund at, of course, his erstwhile organization, returning almost 18% per annum since its launch back in 1994. These are statistics in some ways which, investors, in a way, know by heart. He's, of course, launched his own fund, his own investment firm, and is now managing about 4,000 odd crores and in the market now. Managing funds via the entity 3P India Equity Fund. Mr. Jain, great to have you with us here. Thanks very much for your time. Prashant this side. So let me start by asking you, how's the experience been? I mean, managing funds through your own entity as opposed to HDFC AMC, which in many ways was your entity when you were there, because you were the longest serving fund manager. But this has got to be different, right? So tell us a little bit about that.
I think it's been, I had a very good stint there and I have enjoyed this part also. And what I like about this part is, there are no shareholders to answer. There is no expectations to meet except the customers. I think the investing bit stays the same, but I definitely don't mind the lack of pressure to grow. I think otherwise it's been quite smooth and nice here.
Yeah. One thing I've heard, Mr. Jain, is people who want to invest with you is that they say the minimum ticket size, etc., is too high. Would you plan to, at some point down the line, open it up for the public, or do you think that's unlikely?
No, I think, we are a very small organization. Our head count is about 22, 24 people. So I don't think we are geared to handle a very large number of investors. Currently, we have 140 odd families. I think we'll take that call as we go along, but at this point of time, I don't think there is any plan really to do that.
Okay, got that. Let's just get to the markets then, Mr. Jain. What are your thoughts? I mean, we've had a fantastic run. We are one of the very few markets, large markets, which are almost at all-time highs. Many other markets are closer to their 52-week highs, but we are at all-time highs. What's the overall view?
So I think the economy is doing quite well. And in fact, the tailwinds have improved in India. I mean, because post-COVID, the acceptability of remote working should broad base the offshoring of services. And I think we should create a lot more jobs as global companies shift capacity centers, support centers, back offices, whatever you call it here. I think in manufacturing also, our wage inflation has been the lowest amongst manufacturing countries in last 10 years. So India is now cost competitive in manufacturing. Apart from that, for reasons of de-risking and geopolitics, I think manufacturing will come to India this time around. I'm quite optimistic. And manufacturing is a very large opportunity, much larger than services. So I think GDP growth in India should accelerate compared to last decade. Coming to markets, for 2 years, our markets have been flat. So I think we have had a decent period of consolidation. Our market cap to GDP is now under 100%. Our P's, which had gone up to almost 24 times, I think markets are now trading close to 17 times next year earnings. So I think the excesses are gone. I think these are very fairly valued markets. And barring some global shocks, I would expect markets to do well over the medium to long term.
All right. Hi, Mr. Jain. Good to speak to you. And this is Nigel on this side. My eyes lit up when Prashant asked you about whether you're going to be lowering the ticket size. But I think I'll have to wait a little bit longer, to invest out there. But, Mr. Jain, you have been a value investor, and pockets of value included the PSU space. Now, that index on the whole has done quite well this year. There's a dividend yield that plays out there. Valuations have always been at a bit of a discount as well. How much of that PSU theme has played out? And do you continue to be bullish on a select PSU companies?
Nigel, I am happy to be called a value investor, but value investing should not be confused with low growth or low PE investing. All and value investing means that you will pay a higher multiple for a faster growing business, but not overpay for it. So that's what value investing is. And I think PSUs, one of the reasons why PSUs underperformed, that PSUs mostly are in the economy sensitive sectors. So whether it is banks, commodities, or power sector. And in COVID, the economy was badly hit, and PSUs in general were very badly hit. And that is why markets started clubbing PSUs as a group, which I don't think is the best way to look at this space. But you are right, these stocks have done extremely well. I think the ESG overhang, which again I have said in the past, I thought was not the best way to address that issue. I think that's the markets have overcome that, and you can see how tobacco, defense, fossil fuels, all these stocks have done extremely well. I think the pockets of undervaluation in these markets are very few. This is a very finely balanced market. So in the last 2 years, when markets have been broadly flat, sectors that were excessively valued, I think those excesses have corrected, either because of time correction, like in the case of consumer stocks, or by way of price correction, like in IT stocks. And on the other hand, sectors that were deeply undervalued, like corporate banks, defense, tobacco, power utilities, have gone up between 2 to 5 times. So that those pockets of valuation have also disappeared. So I think these are very fairly valued markets, and even in terms of sectors, the dispersion in valuations, the mispricing is generally not there. So I would not expect these PSUs to re-rate materially in terms of valuations, but yes, to the extent there is earnings growth, I think those kind of returns one can expect even from here on.
All right, Mr. Jain, it's always a pleasure speaking with you, and I'll keep it pretty simple, just the way your investment philosophy is. Your company, 3P Investment, 3P stands for prudence, patience, and performance. So tell us, what sectors would you be prudent about right now? Where do you see performance? And where do you think your patience is likely to be tested in the near future?
So I think what prudence stands for is something very simple, that don't buy a weak, unsustainable business irrespective of price, and don't pay a crazy price for a good business. And if you do these two, and if you are patient with that company, good company, reasonably valued, over time performance is the outcome. So I think that's the thought behind this name, 3P. I think the consumer space, to my mind, looks pretty expensive, though it's a very high quality sector. And I think it might test patience time and again, because this sector tends to undergo more time correction and less of price correction. So if you go back to late 90s, mid 90s, for the next 10, 12 years, some of these stocks remained flat. And what was a 60p became 20p over 10 years. So I think that space, again, to my mind, could test your patience if you are underweight that space. It could on and off, show bursts of outperformance. But other than that, as I said, to my mind, there are no meaningful pockets of either undervaluation or overvaluation. So in a way, this is a pretty straight, fairly valued market with no low-hanging fruits and no very large excesses either.
Okay, got that. So cautious on the consumer space. Prashant, hi, good afternoon. Surabhi here. Want to talk about a space that I think you like, and that's this entire CapEx story that's playing out here in India. And you sounded very optimistic on the prospects of GDP growth as well. Now the question is, how can one play this cycle? Do you think it's a multi-year cycle that started off? Where are we in the cycle? You have capital goods stocks like a Siemens, ABB, which have already run up a lot. Then you have the road contractors, or can you look at defense? But again, defense is a huge rally already that's happened. So how does one play manufacturing and the CapEx cycle, and where are we in the cycle?
Surbhi, that's a great question, but unfortunately, I don't have a great answer because what you said is right. There is promise of growth. I think it should be a multi-year cycle. Corporate leverage is at a 15-year low. Corporate profitability has recovered completely around 4.5% market profits to GDP. Bank balance sheets are extremely healthy. Foreigners want to come in, set up businesses here. Government is very supportive of infrastructure. So I think capex outlook is very strong, and but the markets are pricing this in almost fully. So I would say I don't have any great answers. We have to be, either very patient with this sector and hope that the growth sustains. But ideally, I would like to wait in some of these companies and hope for some corrections, either due to some short-term challenges with the performance. But high quality capex companies are indeed very close to fully valued. At the same time, why I still have a doubt about what I said is if you go back to the previous cycle of from 2000 to 2008, some of these companies compounded earnings at 30-40% a year. I think that is less likely because the base then was extremely low of profitability. But nevertheless, that tells us that when capex picks up and the good companies that have good technical solutions, they can grow at fairly high rates for quite a long period of time. And that's why I want to own that space, but we are a little cautious for reasons exactly what you mentioned.
So, Prashant, I completely understand the caution with respect to valuations, but let me ask you this. Are we in a slightly different normal today? Because what we keep hearing, the narrative that we're getting from a lot of foreign investors, is that money is looking to move away or at least partially move away from China, and it's looking for new homes. And look at what's happened to the Japanese market in that context. We hear that a lot of that money or some of that money might find its way into India as well. If that were to happen, then do we need to be prepared for above normal multiples? And then could the argument on valuation, perhaps do we have to have a new approach towards it?
No, I don't think fundamentally you will change valuations because ultimately it is DCF and DCF is not a function of what markets are paying. But yes, what has happened to several countries is that when a large country has grown ahead of others for sustained periods, the whole world wants to invest there. And it can become very expensive. So I don't think one can rule that out at all. And it is a possibility, it may well play out. Another interesting thing is if you look at the way Indian markets are evolving, the dependence on foreign flows has reduced considerably. Look at the last 4 or 5 years, markets have been either positive or flat despite few years of significant FII selling. So I think equities have moved from a peripheral asset class 2-3 decades back to a core asset class. I think close to 3 lakh crores of money flows into these markets through various formats, EPFO, NPS, insurance, mutual funds, EMS, AIFs, direct equities. That's a large pool of money that is coming in. And still that is only 10% of household financial savings. So I think over time, I feel the volatility of Indian markets will be structurally lower compared to the past when we used to see bouts of volatility linked to global developments. But you are right, if at a time like this when local flows are strong, if foreigners also come in, one should not bank on that, but it can't be ruled out that markets may trade at much higher multiples.
And someone said 10 years ago, the saying used to be go up using the stairs, come down the escalator. It is flipped now. Go up escalator, come down stairs. Oh, absolutely. Mr. Jain, let's just, you said there are no real big pockets of undervaluation or anything. But consumers, for example, which you're underweight on, is there anything there? One complaint with consumer also is that valuations are very high. But within the consumer space, are there pockets where, because some business have been struggling, etc., valuations are at troughs? Anything at lows that you'd want to kind of buy? Anything you like?
So consumer space, I don't think to be honest, like anything. And I don't tobacco does not qualify in the strict sense as a consumer company, though it has financial characteristics of that those businesses. I think if volume growth there sustains, I think that business could still trade higher. But otherwise, whatever I have looked at in the consumer space, I think the multiples appear to be quite rich. Wherever multiples are low or stocks have corrected, these are by and large in categories where the growth prospects are quite, non-encouraging or not so good. They are categories which are either very mature or which don't connect very well with the modern or the young consumer.
Consumer durables as well? I mean, a fixed.
Consumer durables also is very expensive, and you can see this is a low involvement category, and pricing power is a lot lower than the consumer staple space. And markets, in their wisdom, have treated this category like a consumer staples company. I don't think that is right, and I think it will over time correct. And you can see what has happened in the air conditioning space. So I would expect the margins in many of these categories to structurally move over time.
Prashant, I can't let you go before asking your view. You're such a veteran of the markets on what you've made of the consumer technology space. We're talking consumer, and we've heard you sound cautious. But a lot of these companies, the business models have been based on just the way consumers are consuming, right? Whether it's beauty or whether it's you're buying food. Whether it's you're making a payment. Now, the managements, I think, have learned a lesson. They've learned that in public markets, you can't simply look away from profits. The good old-fashioned bottom line is still very, very relevant. We're seeing some of this play up in stock prices. What's your thought process on this? Do these businesses look interesting? Do the price points look interesting to you at all?
So I think, the consumer has moved for sure. So some of these businesses will over time turn out to be great businesses, and they have first mover advantage as well. But I think we have to be, the way I look at this is the business building moats around it? Are the moats becoming bigger as the business grows? I think in the food delivery space, I think the structure of the market is extremely good. I look upon these as logistics companies, C2C. Consumer to consumer, not B2C, not B2B. So I think as scale grows, the competitive advantages of these businesses will deepen. And I think it also matches with the changing lifestyles of more working women, less cooking at homes, and people marrying late, smaller families. So I think food ordering will continue to grow. The market structure is very nice. It's a duopoly, so new entrants are less likely. Of course, these are expensive businesses. These are very expensive. But still, since the growth prospects are decent, I think there is some, my preference would be for that space compared to the other spaces that you mentioned.
All right, we'll leave it there. Mr. Jain, great to have you with us here. Thank you very much for your time. Appreciate your time and thoughts here on CNBC.
Thank you.
All right, well, we've got the